FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
This episode of the Financial Survival Network is brought to you in part by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of over 185 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the New York Stock Exchange American as SAND.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and it's 12/19/18. Hard to believe, but here we are. We've just gotten word the Fed has raised rates, and they're going to cautiously raise them in the future, so they claim. But, you know, the Fed is the Fed, so you got to take what they say for all the nuances and everything else, what it means. Hey, as always, we invite you to participate in the show and email us at kl@kerrylutz.com. And we're getting close to the end of the year, so a little Christmas present for the president, perhaps. Can Trump pull another rabbit out of the hat? Let's see whether that can happen or not. Our good friend Ed Moya of Oanda, he's your chief market strategist there. Ed, welcome to the show.
Hi, Kerry. Thanks for having me.
So, up a quarter. Well, they had to kind of do it. They would have lost all credibility if they hadn't. But it sounds like it was a reluctant increase, doesn't it?
Very much so. And I think what the market is focusing right now is that they did trim their forecast for 2019. So at the September meeting, they had it at 3 hikes for next year. And they did bring that down to 2, which was heavily priced in the market.
Mm-hmm. So we already knew it was coming, but it seems to have knocked the stuffing out of gold, precious metals. I mean, gold was up as high as $8.50 today. It's now down 5.5. Copper's down, getting to that low rate. Crude oil, not much of a response. Dow up 5 points from pretty substantial increase a couple of minutes ago. But if everybody knew this, Ed, and it was supposedly discounted, why are we having this effect here?
Well, it's kind of like that typical you buy the rumor, sell the news type of scenario. But I think when you really dissect what happened, many analysts were expecting possibly an even more pessimistic outlook for the economy. Some were targeting them downgrading their forecast to 1 rate hike. And as you follow the Fed language, there were many calls for them to remove just completely talking about gradual increases. And what the Fed did was they just kind of adjusted that, saying that further gradual increases could be warranted. So this is, obviously they're going to be data dependent. So there was still the possibility that we could have, the Fed resume this tightening cycle next year if we do see a lot of these major risk events in the global economy taken care of. So if the trade war situation is finally resolved, and eventually, believe it or not, the Brexit is a big pain for Europe, and that's really affecting global growth. So if we see those big stories resolved, we could come back in springtime and be talking about how, oh yeah, it's a surprise that they downgraded their forecast, as we're going to see 3 hikes. So there's lots of variables. There's lots of things that have to happen before that could happen. But when you look at the data, the U.S. economy is still strong. It's not as strong as it was in the beginning of the year. And I think that's why you're seeing a little bit of a risk come off after this decision.
Mm-hmm. So the economy appears strong, but it appears like it might have peaked as well. Usually when you get these stellar employment numbers, it's always at the end of the cycle. It's never at the beginning. At the beginning, the employment numbers are pretty bad. Now, by almost any measure, even if we discount the way that the U1 measurement of unemployment has been manipulated over the years, nonetheless, the employment picture was pretty much a bright spot. What do you think is going to be happening for the coming year?
Well, I do think we're going to see softer data as the year persists. And as you mentioned, these economic cycles, we are, going through possibly the end of a record length. So the current expansion, if it does last to the second quarter of next year, that'll tie the 40-quarter expansion record for that we saw in the 90s. So it's definitely something that the market is well aware of. At these end of these key cycles, a lot of times what we'll also see is some of the key defensive plays really outperform. So whether it's pharmaceuticals, staples, utilities, you'll notice if you compare, where we've seen some of the key weakness, it's been in the autos, the building, the bank stocks, the tech stocks, and so you're exactly right that we're nearing the end of the cycle. But if we take a look at the data is still we're still looking to grow at 2% by the end of next year, and possibly, if you believe the Fed forecast, even for 2020. So it's yes, things are looking not as great as before, but it's still at 2% growth. That could still be positive for risk on environment for U.S. equities and also for possibly the U.S. dollar.
So here's a question for you, Ed, one that I really don't know the answer to, so I'm asking you. Is the economic cycle coming to an end just because, like you said, 40 quarters, how many more can you expect? That's 5 years of growth. Or is it the interest rate hikes that have, in the words of, I guess, Greenspan or his predecessor said, taking the punch bowl away from the party? And is that doing it, or is it a combination of the two?
It really is a combination of the two. And we will see the Fed continue to tighten, and eventually they will, have that yield curve inversion, and it will provide us with a recession. It's that word recession scares a lot of people, but for when you study economic cycles, it's bound to happen. So it's not really sustainable for the largest economy to continue to grow at a record pace. So eventually this is going to come to an end. But if looking at the data, and if we do see a lot of these major global risk events have a positive outcome, we could start to continue to see the U.S. economy still remain strong.
Yeah, and so let's switch gears to oil, because that's still a major part of the economy, the U.S. economy, the world economy. Right now, we see that the price has really, I don't want to use the word crashed, but has declined to under $50 the barrel. It's $47.09 as we speak right now on the spot. And that's something that definitely affects the economy in a lot of different states, a lot of different industries within the U.S. and the world. What is going on with the oil price here?
Well, it's quite a story. I mean, 2 months ago, oil was roughly 30% higher. And when you take a look at yesterday's price action, that was pretty interesting. We saw it as low as 8%. The fundamental story that took oil from 77 all the way down to 46 and change. Those fundamental drivers pretty much still remain. When you talk oil, you're always talking about supply and demand, oversupply with the three largest countries, Russia, Saudi, and the U.S., all producing near record levels. And with the slower growth concerns, as we've seen weaker data in Europe and China, that has really been driving this move lower. Now, as far as the OPEC meeting that we saw at the beginning of the month, they delivered their cut, and it was a hard-fought battle. And you could see that all the gains that were seen after the OPEC and allies delivered their 1.2 million barrels a day cuts, that's been washed away. And you're going to see those concerns of supply really dragging this commodity down, because with U.S. shale production, it's here to stay. And I think that many people are now focused on, what happened in 2014? Well, OPEC was really trying to destroy the shale industry. They really wanted to wipe out the shale business. So what did they do? They allowed oil prices to go from $100 a barrel all the way down to 30. Well, shale has survived, and right now, a lot of these key OPEC countries, they really don't want to see oil near these low levels. They're conceding. They do know that shale is going to survive, and all the forecasts. If you take a look at the longer term pictures, the IEA, they're looking, for the U.S. to make roughly 75% of the global oil in 2040. So that's way farther than we want to talk about right now. But OPEC now, they need to try to keep their relevance. They need to try to make sure that they can have this their prices stabilized, because a lot of their members, if we continue to see oil near the low 40s, that is going to be something that they can't tolerate, and eventually, that would be very hurtful, because you could see the dismantling of OPEC. So as we saw, Qatar is going to leave in January, and then everyone's focused on Iran. So there's lots of moving parts here, but I think yesterday we could have seen a key low with oil, or at some very interesting technical levels. So the fundamental drivers completely support the move lower. Oversold, yes, but it's an area that eventually, when we do start to see if the U.S. economy remains strong, if we do see a lot of these other risk events taken care of, then you could eventually start to see oil prices stabilize on the stronger demand side.
Mm-hmm. So demand, though, if there's two sides to the equation of oil prices, obviously supply and demand, and it looks like demand is somewhat down in China and in other developing countries. Could this be flashing a signal for a global economic correction?
If you look at some of the charts, it looks like we're already in it, and the weakness is very persistent. The one optimism is that if we do start to see China stabilize, if we do start to see China, if China can resolve this trade war, and if we do see the PBOC become more, if they surprise the markets, and if they ease, we could start to see a little bit of a recovery with that, and that could be a positive domino effect on affecting all of its neighbors and the rest of the world.
Yeah. Oh, for sure. And yeah, you have to wonder, oil price, the thing that happens, and we've seen it so many times, we both grew up in New Jersey, which used to have low oil prices, gasoline prices compared to its neighbors, not so much anymore. But New Jersey was a major producer, refiner of petroleum products. And, what we always saw is that when these prices got to these high levels, didn't know when, but they were going to crash. They're going to go bust at some point thereafter, and that would help bring supply into line. Now, it doesn't seem to be having much effect. Low prices encourages the shale producers to produce more so they can cover their costs. And distillates, which don't really get talked about much, or I should say liquids, natural gas liquids, are really, they keep going up, they keep increasing. So, and, for the prices, obviously a producer gets a lot more for wet gas than dry gas. There's a lot of dry gas holes that were plugged up until the past couple of months, the past 6 weeks, when nat gas shot up over $4, brought a lot more supply onto the market. I guess what I'm saying is the market isn't really functioning. Petroleum markets, global petroleum markets, are not functioning in the way that they used to function.
Couldn't agree with you more.
I know that was a lot.
Ever since we saw the adoption of high-frequency trading and the algos, it seems that every major oil move is just multiplied by like 5.
Mm-hmm. Yeah, yeah, it's that. So certainly trading, but supposedly all the major banks got rid of their proprietary trading. I guess they just gave it off to hedge funds, right? It doesn't look like a whole lot has changed. So is it the tail wagging the dog here, the algos that are doing this? There's got to be some market fundamentals taking place that are causing this, right? Or is it just all technical?
I would say it's definitely a combination of both, but the fundamentals have been leading the way in this most recent move.
Mm-hmm. So we're kind of like in a wait and see situation. See if stocks break crucial resistance points from, I guess it was February. If we break them, then we could be seeing stock prices go much lower. If they don't break, they might just hang around these levels or even go higher again.
And that's kind of where we are. And it's interesting with the December spin conditions that we typically see at the end of the year. There's anything possible in December, as you know, as you look past over the last several years, we could see heightened volatility, and with lots of major risk events out there. And anything really is possible over the next couple of weeks.
Yeah. So you remember a time period that's been this uncertain? I mean, obviously 08, 09 was one of those time periods, but this one is like it could go either way. It could go any way. Can Trump pull a rabbit out of the hat, make peace with China, get most of what he wants, and the party can continue on, or everybody digs in their heels, and then we have a real situation?
Well, I think the president has made a lot of progress with the trade war with China. Some of the key issues, the forced technology transfers, intellectual property theft, we are starting to see China come out with some measures to, for the most part, punish companies that are in violation. We are also seeing they have addressed some of the concerns about opening the markets. We're nowhere near a final framework for an agreement here, but we are starting to see the Chinese make concessions. So the president has made progress, and as we approach these deadlines, there's more incentive for China to come together here with the U.S.
And I guess wasn't really going to stray into this, but I think it's a great point. I guess the Chinese found out they're a bit more vulnerable than they thought they were, huh?
Very much so. And if you follow certain companies in China, you can take a look at the Huawei story. You can take a look at what happened to ZTE and some of these companies that were punished for dealing with Iran. There is fragility in China right now, this is actually a critical week for China. President Xi, did speak the other day, did not really announce any measures. There were many that were expecting him to, but over the next few days, they are having their policy setting meetings for next year. So we're really getting into the nuts and bolts as far as they really are needing to have a short-term view right now, and they do need a win, and resolving this trade war would really alleviate a lot of their pressures domestically.
And it would give the stock market an excuse to go higher, right? And that could be just what it needs.
Yes.
Yeah, it's a fascinating time. It really is. Hey, Ed, if we want to find out more about you, connect with you on the web, where's the best place to go?
So every day, I'm part of the Market Pulse team for Rwanda, so marketpulse.com. And I do tweet all my articles. I do tweet some interesting observations I have on the markets. My hashtag is EDJMOYA.
Excellent. Hey, okay, so I just got something from Seeking Alpha, 10-year yield slides after surprise Fed hawkishness. I mean, I kind of wanted to conclude, but we can't ignore this. It's basically down the 10-year to 2.79. It broke 280, which is kind of a key point, not a super major one, but a pretty major resistance point. And what do you make of that?
everyone's focusing on that they did not remove the gradual increases. And I think that if we do start to see some of these bigger stories taken care of, and if the data does not fall off a cliff like many have reacted, we eventually could see the yields eventually climb higher, but I would not get in the way of this move.
Yeah, don't catch a falling knife. All right. Hey, well, it's great having you on, Ed. Hey, for all of you out there, just email us any questions, comments, kl@kerrylutz.com. If you're listening / watching on YouTube, then please subscribe, like, and share us. That really helps a lot. It really helps the show. And if you're just listening through conventional means, website, podcast, etc., why don't you share the show with somebody who you think could benefit from it? I hope it's entertaining and enjoyable, and we do get really bright people on the show, such as Ed Moya. And Ed, really appreciate you coming on, and we will talk to you after the new year. Happy and a healthy holiday and new year to you and yours.
Oh, thank you so much. Great to be on, and happy holidays right back at you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.